The CME FedWatch tool has the probability that the federal funds range will be 100 basis points lower than now on or before the December 2025 meeting at 68.4% as of the close yesterday, Friday, April 4th, 2025. The probability was over 80% intraday on Friday, which I noted in a comment to my blog, before Fed Chairman Powell started to talk and made it clear that the Fed was in no hurry to cut interest rates again. It wants more time to assess the uh, impact of tariffs on U.S. growth and inflation. The current range is 4.25 to 4.5%, so a 100 basis point cut in that range will take the FF range down to 3.25 to 3.5%. CME is an abbreviation for the Chicago Mercantile Exchange. The yields on short-term instruments like treasury bills and money market funds will quickly adjust down to reflect cuts in the federal funds rate. The probability of at least a 25 basis point cut on or before the June 2025 meeting closed yesterday at 94.4%. The CME FedWatch tool, for those unfamiliar with it, can be found online by Googling that phrase. The tool assigns probabilities to future federal funds ranges based on the federal funds futures contracts. It is a crowdsourced opinion among mostly knowledgeable investors. As with any future prediction, the probabilities may be too high or too low or close to being a present forecast at the time. I have to take the probabilities of interest rate cuts into account since I do own a lot of treasury bills purchased at auction, and those yields will be coming down to adjust to the lower federal funds rate if the Fed does in fact cut the federal funds rate further this year. Corporate bond yields have also fallen significantly over the past month the making them less desirable to me. I have a constant flow weekly of proceeds from maturing corporate bonds that need to be reinvested. The recent declines in yields, plus the FedWatch tool forecast of lower short-term yields later this year and into 2026 based on cuts in the federal funds rate, is going to force me into buying more dividend-paying stocks starting very, very, very slowly next week. Since I will not be doing any stock selling next week, having already slashed my stock allocation to the lowest level it has been in a very, very long time, I will probably have enough stock buys next week to publish a weekly post probably next Saturday or Sunday. The decline in the stock market last Thursday did not impact my portfolio much. I was close to break even as the gains in my bond heavy portfolio almost recouped all of the losses of my stock allocation, which is close to 7% of the total. That was not the case last Friday. As an example, my Fidelity account, one of my 4 taxable brokerage accounts that I have, was down 0.37%, even though the stock weighting is only about 8%. The third-party services used by brokers to price the value of bonds, invariably at below market prices, I would add, had my municipal bonds owned in that account up $914.50. And there were gains in all of the treasuries that I owned in that account, and less of a robust gain in corporate bonds than last Thursday. So I really got drilled in my dividend paying stocks some. and some of those were actually up on Thursday. I actually did some selling on Thursday. There were 1,042 new 52-week lows on the New York Stock Exchange last Friday and 1,479 new 52-week lows on the Nasdaq. The S&P 500 has not yet crossed a 20% decline from its 52-week high hit in mid-February 2025. During my lifetime as an investor, which started in the late 1960s, there have been 8 declines greater than 20%, and of those 8, 3 were greater than 40%. And of those 3, 1 was greater than 50%. So I've been through a lot worse and managed to survive and prosper. You can find charts of bull and bear markets by Googling Yardeni. That's Yardeni research, bull and bear markets and corrections. So I will be buying some dividend stocks next week.